Hello class, this is Dr. Fenton. In this video, we're going to look closely at the statement of cash flows. Now this statement shows a lot of valuable information about cash in the business. Where is the cash coming from? What sources? Where's the cash going? What are you using the cash to buy or to pay for? So this is a very valuable statement. Now, to me, this is one of the most important statements that there are. We have the four financial statements. And personally, I think this is the most important one. You need to know about your cash flow. Again, where's your cash coming from? How much is coming from your regular operations where you're generating cash from customers, whether services or goods you're selling? Where's the cash going as to expenses? How about paying cash to buy long-term assets like land, building, equipment? What about financing your business? How much cash are you receiving when you're borrowing money? When you sell stock during the year? How much cash is going out in the form of dividends? So this statement shows you a lot. It shows you really everything about your cash flow. It's a very difficult statement to prepare, and we're going to go through it step by step to learn how to prepare it. But this is a very valuable statement for any business. So let's get started. Next page. Here is an example of a statement of cash flows. We have, first of all, cash flows from operating activities. And you can see we will start with net income and then make some adjustments here to end up with, and this is an important subtotal, net cash flows from operating activities. You need to get this one first. Then we're going to go through the investing section, find out about this cash flow, and come up with net cash flows from investing activities. Then finally, the financing activity area, stocks, bonds, dividends, and so forth. Net this out and have this third subtotal, net cash flows from financing activities. Then we summarize everything at the bottom and tie these changes into the balance sheet. And we're going to go through this step by step a little bit later. Now in the operating activities section, this involves cash flow from revenue and also expenses, cash inflow, cash outflow. The investing area, you use cash to buy equipment, buy land, buy buildings, buy long-term assets, or you might sell some of those. So how much cash are you receiving or paying in this area? And finally, the financing area. This is cash being received to finance the business. Are you borrowing money? Are you selling stock? Are you paying dividends? Are you paying back some of the long-term debt? So again, remember we have three main areas: the operating activity area, investing activities, and then financing activities. So here's a little bit more about these three areas. First of all, operating. Cash inflows will come from the sale of goods or services to customers and clients. Also collecting any interest and dividends, as income, as revenue. Cash outflows in this area include inventory, all of your various operating expenses, paying interest and paying taxes. The second area, investing activity, cash inflows. Are you selling investments? Are you selling some of your long-term assets like land, building, equipment? Are you collecting on notes receivable? Or are you buying some of those? So cash outflows. Cash flows from financing, again, relates to financing your business. Are you issuing bonds to get money to use in the business? Or borrowing money in the form of notes payable? Are you issuing more stock during the year? And are you, on the other hand, cash going out, paying off the bonds or notes? Are you purchasing treasury stock? And are you paying dividends? So again, remember, three main areas: operating, investing, and financing. Here's a chart that might help clear this up a little bit. So in the operating activity area, we are going to get information from the income statement, also from current assets. Notice this says other current assets, not all current assets, not cash. So we're going to look at the changes in other, in other words, non-cash current assets. And we are going to look at changes in current liabilities. So these come up here. In the investing section, we're going to look at changes in long-term assets. And finally, financing, we're going to look at long-term debt and your equity section, stock and dividends and so forth, and treasury stock will go in here. Now there is another area outside those three we just talked about, and this is the non-cash activity area. Now let's look at this. A typical situation is where a company borrows money, let's say $200,000, has the cash, and then uses the money to, let's say, buy some equipment. Okay, this would show up as a financing activity where cash is coming in the door from borrowing money, because we do have the cash. And then it would show up as investing activity where we're paying the cash out the door to buy equipment. Now what if we just buy the equipment and sign a note? So no cash is being transferred. This is like maybe car dealerships might offer 100% financing. So you go in and buy a new car and just sign the note. You don't pay them any cash. Now you will pay cash later on, the payments, but at the very beginning you don't pay cash. So that is a non-cash transaction. So like it says here in this blue highlight, if you just sign a note and then you have the asset and you don't receive cash or pay cash right here, no cash is transferred here at the beginning, this is a non-cash activity. This is still significant. So we need to report this as a non-cash activity, but it does not go up in the operating, investing, or financing areas. In fact, let me go back up here to the statement. It would go down here. After you're finished with all your cash flow numbers, then you would have note, non-cash activities, purchased equipment by issuing a note payable. In this case, $20,000. Our example below was $200,000. But this is to show a significant activity where no cash is transferred. Let's go back down here. Went through there. Okay, so on the next page. This is preparing the statement of cash flows. Now, we need the income statement, so we'll come back to these numbers in the rest of the example in the next several pages. So net income $42,000, various expenses, depreciation $9,000, loss and sale of land $4,000. I point those out because those will be important in just a minute. Then now the balance sheet. We have last year's balance sheet, this year's balance sheet. Of course, we're a year ahead here, 2021. But we show the differences in all these accounts. So you're just subtracting. So cash went up $14,000 from the end of 2020 to the end of 2021. And receivables went up, inventory went down, and so forth. You don't need a total here, so don't worry about this. And let's see, current liabilities. Again, find the changes. Accounts payable went down $5,000, interest went up, decrease, increase. And get down to stockholders' equity, we have increase here in stock, and then retained earnings. Even though we're not going to use this number specifically, it did go up $30,000. They give us other information. They purchased stock in another corporation. They sold land, costing $10,000 for only $6,000. There's the loss of $4,000 right here, loss of $4,000. But we need to know this cash flow number, the $6,000. Purchased equipment by issuing a note payable. Issued common stock, and then declared and paid a cash dividend. So we'll need all this in just a few minutes. Now again, the purpose of the statement of cash flows is to report the activities that cause the change in cash balances reported in the balance sheets from period to period. Let me go back up. We are trying to find all the transactions that occurred cash-wise and come up with this $14,000 increase. So we're going to go through the operating section, the investing section, and the financing section, and then come up with the net change in overall cash of the $14,000. We are going to use the indirect method. This is the method that most companies use in the annual reports. There's the indirect and the direct. But we're going to use the indirect method again because that's what you will more likely than not see in someone's financial statements. Here's what we're going to be filling in. This is the overall format. We start with net income, and that came from the income statement. Then we're going to list the differences in the non-cash current activities and the current liabilities. And we're going to look for a few other things out of the income statement, and for example, depreciation and that loss on sale of land. And then we'll look for investing activities and then financing activities. So this is the overall increase in cash. So these three numbers, when we finally come up with these in a few minutes, these will need to net out to $14,000 increase. And then when we take the $14,000, add to the beginning cash, we'll get the ending cash. I want to show you this again. Let me go up. So 14, 48, 62. It ties directly right here. Here's the 14 increase, last year's balance, add, and get the 62. So this cash flow statement at the very end will refer back to these numbers. We prove this change. We prove it through going through the three sections: operating, investing, and financing. Okay, next page. Indirect method. Now under the operating section, we're going to, of course, start with net income and then learn to handle the non-cash items and the non-operating items, and then get into the changes in those other non-cash current assets and then the current liabilities. Here is something you'll need to memorize, and then once you memorize it and use it a few times, you'll understand why we're making these changes. And I'll explain this as we go through. So make sure you have this handy. This is very important to know when you're preparing a statement of cash flows. Now, a non-cash item, okay, depreciation expense. We see this in the income statement. Remember, the entry to record depreciation expense is to, as an adjusting entry, debit depreciation expense and credit accumulated depreciation. With that entry, again, debit the expense, credit accumulated depreciation, that is not a cash flow entry. Cash flow is not affected. It goes to the income statement and it lowers net income. It lowers net income, but it's not a cash flow number. So what we need to do, since we're trying to change the net income figure into a cash flow from operations figure, we're going to add back this depreciation expense. Again, why? Because we used depreciation expense to reduce net income and it did not use up any cash, that entry. We're going to add this back to net income to get more of a cash flow number. So you can see our very first step in the cash flow statement after you list net income. Again, this is the very first one. Don't have anything else first. Add back depreciation expense. Put net income down. Go straight back to your income statement. Look for depreciation expense. Add it. There's no other choice. Put it down here and add it. Now we're going to look for non-operating items. These are items that are not in our regular course of business of buying and selling things to customers or providing services to customers. Okay? So we did have a loss on sale of land. Remember back in the income statement, it said loss on sale of land $4,000. Well, that $4,000 was not a cash flow number. That was the loss. If you remember the data they gave us earlier, they said they sold the land for $6,000. The land cost us $10,000. So the loss is $4,000. But when we sold the land for $6,000, we didn't lose cash of $4,000. We had an accounting loss of $4,000. So this loss, sort of like depreciation, decreased net income, but it was not a cash flow number. This is not cash going out the door. So we add back a loss on sale of land. Now the opposite of this, if we had a gain on sale of land, we would deduct the gain. Add back the loss, deduct a gain. And this would be land, it could be buildings, it could be equipment, it could be long-term investments. So if you have a loss, add it back. So this is the depreciation is the non-cash item. The loss on sale of land is the non-operating item. So that's how you start the operating activity section. Now we're going to look for non-cash current assets and how they changed from year to year. So what we'll do, if we have accounts receivable that increased, we put a negative $7,000 down. You might think, well, is it an increase good in accounts receivable? Well, don't think good or bad. Think of cash. Now, if we record an increase in receivables, like, for example, we sell something for, let's say, $7,000 on account, we debit accounts receivable, credit revenue. Revenue goes up, but cash did not come in the door. So it increased revenue, so it increased net income, but if our receivables also increased, that means there's that much cash we did not have that came in the door. So we're going to subtract an increase in accounts receivable. Because you don't have the cash in your hand. The cash is tied up in receivables. You don't have it yet. So if receivables go up, there's cash you're going to collect in the future. You did not collect it this year. So subtract an increase in accounts receivable. And what we're going to do, the pattern here is for any non-cash current asset, we are going to subtract an increase and add a decrease. It works this way for accounts receivable. It works the same way for all other non-cash current assets. So if your inventory decreases during the year, we're going to add the decrease, because this is an expense we recorded and cash did not go out the door this year. It went out the door last year for this inventory. Our inventory went down. So we're going to either subtract an increase in inventory or add a decrease. And we're adding the decrease. That's why I said that schedule a few minutes ago. You need to memorize it, have it handy, because it's kind of difficult to understand at first. But the rule is, for any non-cash current asset, if it increases, subtract the increase. If it decreases, add the decrease. Prepaid rent. It increased, so we subtract it, because we paid more cash than we expensed. So that account increased, so we subtract it. Now we go to current liabilities, and the rule is just opposite. Here's where it gets confusing. The rule is opposite. So if we have a decrease in accounts payable, we subtract the decrease. Now notice in the non-cash current assets, if they decrease, we add them, we increase it. But if we have a decrease from last year to this year in accounts payable, that means we paid out cash. And so we put the negative here. This is cash flow that went out the door, negative $5,000. Interest payable. If our interest payable account increases, we add the increase. Because how do we get interest payable to be recorded? We debit interest expense and credit interest payable. And so if our interest payable increases, that means we're recording that expense, interest expense. It reduced net income, but it did not use up any cash. So again, we're converting net income with all these adjustments to a cash flow number. So we increase here $1,000, the increase that we had in interest payable. Decrease in income taxes payable. We have a decrease in income tax payable. We put this down as a negative number. Cash went out the door to make us decrease that income tax payable. So we've gone through by starting with net income, add back depreciation expense, look for non-operating items. We add a loss on sale of these long-term assets, but you would subtract a gain if you had a gain. Then we go through the non-cash current assets. We have 3 of these. Then all the current liabilities, 3 of these, they were on the balance sheet. And you can see the pattern here. If a non-cash current asset increases, we subtract it. If a current liability increases, we add it. Again, that's just the pattern that we use. Okay, so go through here, then make sure you don't forget this number. Start here, we add and subtract all these and get net cash flow from operating activities, $50,000. This is, to me, one of the most important numbers in all 4 of the financial statements. To me, this is really more important than net income. This shows you in your operations how much net cash you are receiving. This needs to be a positive number. Now, you might go several years with this being a negative number. If that's the case, that means you're having more cash going out the door just from operations than cash coming in. You cannot have that very long. So you want this number to be positive. Net cash flows from operating activities. Okay. This is the first section in the cash flow statement. This is the most difficult one to prepare. So go back through this example, listen to this part of the video again. Go back to your textbook and follow the numbers through. Okay, let's see here. That's just another example you can go through. Next page. In the investing activity area, we are looking for changes in your long-term asset accounts. Now, the information given to us previously said that the investments account increased by $35,000 during the year. So we used $35,000 in cash to acquire more investments. Also, we sold some land. The earlier information told us that we sold land that had a cost of $10,000 and we sold it for $6,000. So we had that loss of $4,000. Now I want to show you where these numbers are coming from. So let's go back to illustration 6. Let me click here. And here's the balance sheet that we're referring to prepare this statement that we're going through. You can see investments went from 0 to $35,000. So we used $35,000 cash to buy some long-term investments. That was purchase of stock of another company. Land, you can see, went down $10,000. Come down here and here. Land sold, sold land originally costing $10,000 for only $6,000. In other words, cash came in the door at $6,000. The land had cost us $10,000 when we bought it, let's say several years ago. So there was the loss of $4,000. So the information we're going through in the statement is coming from this balance sheet. We just went through the operating section area. We used some income statement numbers and some balance sheet numbers. So let's continue to use this. Let me catch back up to where we are. Here's the investing area. Okay. Now I see an error the publisher had. I have it highlighted in red right here. This should state investing activities. So that is an error. So it should state cash flows from investing activities. So we're going to put down here purchase of investments and put down a negative $35,000. Now a lot of people think, wait a minute, our investments went up. We should put a positive $35,000 here. But you have to remember, we're looking at what happened to cash. Cash went out the door. Cash decreased because we bought these investments. Yes, it's good to buy investments. You have the extra cash. But this statement is showing us what's happening to cash. We used $35,000 of our cash to buy investments. When we sold the land, we had $6,000 cash coming in the door. Don't place here your $10,000 or your loss of $4,000. Put down here cash. We sold the land for $6,000 cash. Cash goes in this section. And so again, we purchased investments, negative cash flow. We sold land, positive cash flow. So to net this out, negative $29,000 in cash going out the door. We also have this non-cash activity. Remember, they purchased equipment by issuing a note payable $20,000. So no cash changed hands when this was purchased. They just signed a note. This goes at the very bottom of the statement of cash flows. Next section, financing activities. Here we're looking for notes payable, bonds payable, common stock, treasury stock, and dividends. So with the information given to us, it looks like they increased notes payable $20,000 and they sold some more common stock $5,000. Oh, I see the same error here. This should state cash flows from financing activities. So again, this operating should be financing. You can see it said financing here. So again, this is the publisher's mistake right here. Now, in this area, if they issue common stock, then cash came in the door because they sold common stock, so plus $5,000. If they pay dividends, that's cash going out the door, so minus $12,000. If they had borrowed money through bonds or notes payable, you would show a positive number. If they paid off some bonds or notes payable, you'd show a negative number. So net these two out. So net cash flows from financing activities minus $7,000. I wouldn't worry about retained earnings that much. Doesn't really apply here. dividends paid, we covered that. And then we combine the net flows from operating, investing, and financing. So here we go. So here's the statement we just went through prepared. Operating activities, remember, net income, add back depreciation expense, add back a loss on sale of land, take care of your changes in your non-cash current assets and all of your current liabilities down through here. Make sure you get this subtotal, net cash flows from operating activities. Go through your investing section. Here's the next subtotal, net cash flows from investing activities. And then your financing, same thing, net these out, net cash flows from financing activities. So positive 50, negative 29, negative 7, nets out to $14,000. So this is our net increase, and B in brackets is decrease, but it's an increase here in cash. So we're showing through all these areas, these three areas, where the cash came from and where it went. They all net out to $14,000. And if you remember, this ties back to the cash balances in the balance sheets. Last year's and this year's and the change. And then we have the non-cash activity here where you signed a note for equipment. So here is your statement of cash flows. So I can barely get it all on the screen here. Again, it's very difficult to prepare. You'll need to go through it 2, 3, 4, 5 times. But once you do it several times, then you start to learn and better understand what's going on. But the main thing is, in the first section, through your regular and continuing operations from, raising revenue and cash from your customers, selling items, services, so forth, paying expenses, net all that out and change it to cash. Here's the cash your operations are generating. Now you're using some of that cash to buy investments. You have excess cash, and you generated some more cash selling land, maybe some land you didn't need. You paid a lot in dividends, raised a little bit in selling common stock. So it shows you what's happening with cash here. So it shows you the three main reasons why cash is changing: operations, investing, financing. Here's the net change in cash from last year to this year, beginning cash balance and ending cash balance. All this ties together. So 14 plus 48 equals 62. So there's your cash flow statement. One more time, I think this $50,000 here, net cash flows from operating activities, is probably the most important number in all four of the financial statements. And this is another example you can go through. Next page, cash flow analysis. There are a few cash flow ratios that we can talk about. Now, if you remember return on assets, this is just net income divided by average total assets. We saw this earlier, back in chapter 7, in fact. And you could, if you wanted to, compute a cash return on assets. Now, you don't see this ratio very often. You rarely hear about it. So it's not that important, I don't think. But if you wanted to compute it, you take your operating cash flows. That's from the first section in your statement of cash flows. Divide that by your average total assets, and you get a cash return on assets. So there are the numbers for Apple and Alphabet. And then don't worry about this part here. And here's turnover as to sales. We covered that earlier. And that's about it here. So let's look at the next page. Now the direct method in the appendix, don't worry about it. Okay, so just forget about this. And then that's going to be the end of the chapter. So it's an important statement, a statement of cash flows. It's very difficult to prepare because you're taking numbers from the other financial statements and put them together in what first looks like sort of an odd manner, but it eventually does make sense. But again, it does show you where your cash is coming from and where it's going. And that's what any owner, any manager needs to know. So anyway, an excellent chapter. So good luck with your studies.